I used to think parking garages were one of the simplest businesses in real estate. I buy a piece of land, build a concrete box, paint a few hundred white lines on the floor, and charge people for leaving their cars there. No inventory, no products going bad. Once the building is finished, drivers arrive, tap their cards at the gate, and money lands in my account. That was the idea that brought me to Austin, Texas. My name is Ethan Brooks, and I had spent years looking for steady cash flow. Austin seemed perfect. Apartments were rising, offices were opening, and traffic kept getting worse. Everywhere I looked, I saw cars. To me, every car represented demand. If thousands of people were driving into the same neighborhood every day, I assumed somebody had to make money storing those cars for a few hours. The first property that caught my attention was near a fast-growing mixed-use district. Offices, apartments, restaurants, and new developments surrounded it. On paper, it looked like the kind of place where parking would become more valuable over time. My plan was to build a multi-level garage with roughly 500 spaces. At an average parking price of $25 per vehicle per day, the math looked great. If I could fill 400 spaces per day, that was $10,000 in daily parking revenue, or around $300,000 over 30 days. For a moment, I felt like I had discovered a giant concrete vending machine. Then I started calculating what it would cost to build one. The land came first too. Parking garages need something every growing city makes increasingly expensive: a large piece of land where people already want to be. The better the location became, the more I had to pay before earning a single dollar from parking. Then came architects, engineers, traffic studies, drainage plans, permits, legal work, and financing, and I still did not have a garage. After that came the structure itself. I needed ramps, lighting, elevators, ventilation, cameras, payment systems, concrete, and steel. The structure had to survive daily use. Every requirement pushed the budget higher. But the part that changed how I looked at the project was the loan. I was not paying for the entire garage with cash. Like many real estate projects, mine depended on debt. The moment construction money started being drawn, interest started accumulating. The garage did not care whether it was open. The bank did not care whether customers had arrived. I could have excavators on the property, concrete rising from the ground, and zero parking revenue coming in, while interest continued growing monthly. That was my first major realization. I had assumed my biggest challenge would be getting enough cars into the garage after I opened. It wasn't. My first challenge was surviving financially long enough to open at all. If construction took longer than expected, I paid more interest. If material prices increased, I needed more capital. If permits were delayed, my site could sit there producing nothing while financing costs continued. Every month of delay created two problems: another month of financing expense and another month without parking revenue. Time itself had become a cost. I also started looking at the land differently. Once I committed the site to parking, I gave up every other use. Apartments or retail might eventually create more value. That was the opportunity cost hidden inside the project. And if my costs came in far above my estimate, I could not simply keep raising parking prices. Drivers had alternatives. They could use another garage, street parking, rideshare services, or public transportation. That was when the business stopped looking like a concrete vending machine. I was not really investing in a building. I was making a very expensive bet on future parking demand. And once I understood that, one question became more important than how many spaces I could build. I needed to know how much money each one of those spaces could produce. Once I understood that every parking space had to justify the money tied up in the building, I stopped thinking about the garage as one business. It was really several businesses stacked on top of each other. The obvious one was parking itself. I could charge by the hour for short visits, by the day for commuters, and by the month for people who wanted guaranteed access. Each customer behaved differently, and the same space could produce completely different revenue depending on who used it. A space rented to one monthly customer gave me predictable income, but it might sit empty while that customer was away. A space sold by the hour could turn over several times in one day. That changed the way I looked at occupancy. A garage that looked 70% full could still outperform one that looked 90% full if cars were constantly entering and leaving. Turnover was money, so I started building a revenue model around time. If I could attract different groups at different times, the same concrete space could earn money more than once during the day. Then I started looking beyond parking fees. EV charging stations were an obvious addition. If drivers were leaving electric vehicles parked for hours, charging could turn waiting time into another transaction. Advertising was even simpler. The garage had walls, payment screens, and entrances seen by thousands. Some could create advertising revenue. Premium parking created another layer. Spaces closest to elevators and exits were more convenient. I could charge more for the best ones. I also considered a small car wash service. A customer could arrive needing somewhere to park and leave with 2 services completed, but the biggest opportunity was outside the garage. I started approaching nearby offices, hotels, and apartment buildings. An office could reserve spaces for employees. A hotel without enough parking could send guests to me. An apartment project could secure spaces instead of building as much parking of its own. Those agreements could give me something hourly customers never could: contracted demand. That mattered because parking revenue can be volatile. Rain changes traffic. Holidays change traffic. Remote work changes traffic. A competitor can open 2 blocks away. A contract does not remove those risks, but it can create a base level of occupancy before drivers even arrive. Then I noticed another piece of the Austin market: events. If a stadium, concert venue, festival, or entertainment district was close enough, parking prices did not have to stay constant. On an ordinary Tuesday, I might need competitive pricing to attract commuters. On a sold-out event night, hundreds of drivers could arrive within the same hour, competing for limited spaces. That gave me pricing power. A space I normally sold for $25 could potentially earn several times that during a major event. At first, I thought event parking would be pure profit. It wasn't. Events meant traffic jams, longer security hours, more cleaning, more pressure on staff, and heavier use of payment equipment. If vehicles flooded the exits at once, a bad traffic plan could turn a profitable night into a customer service disaster. Still, the main lesson was important. The value of my garage was not determined only by how many spaces I owned. It was determined by how intelligently I sold the time inside those spaces. That was my second major realization. I could build a 500-space garage and still struggle if I priced it badly, attracted the wrong customer mix, or depended on one source of demand. Or I could make the building more productive by combining hourly parking, monthly contracts, premium spaces, EV charging, advertising, car washes, and event pricing. The concrete did not create the profit. Utilization did. And once I started thinking that way, I realized the next problem was more dangerous. Because even when cars were not entering the garage, the bills would keep entering my account. Once I understood how many ways the garage could earn money, I made another mistake. I started focusing too much on revenue. But a parking garage has a dangerous feature. It keeps costing money even when almost nobody is using it. The loan payment does not shrink because Tuesday is slow. Property taxes do not care whether half the building is empty. Insurance still has to be paid. The lights stay on. Security cameras, payment systems, elevators, ventilation, cleaning, maintenance, and security still cost money. That changed the financial model completely. Most of my biggest expenses were fixed or semi-fixed. If my garage was 90% occupied, I paid them. If it was 45% occupied, I still paid most of them. So occupancy was not just a measure of popularity. It was the difference between spreading my costs across hundreds of paying vehicles and forcing fewer customers to carry the building. I started thinking about a garage owned by another investor, Marcus Hale, in Chicago. His property looked safe when he bought it. It sat near several large office buildings, and Marcus built his projections around commuters. The morning rush filled his spaces. Monthly passes and company agreements gave him predictable revenue. For years, the model looked stable. Then the offices changed. More companies allowed employees to work remotely. Others reduced the number of days people came in. Some tenants downsized. Marcus did not lose every customer at once. Demand leaked away slowly. A driver who used to park 5 days a week came in 3. A company that once paid for 80 monthly spaces renewed only 35. The garage still opened every morning. The insurance bill still arrived. The property tax bill still arrived. The loan still had to be serviced. But fewer cars were paying those bills. That was the nightmare hidden inside the business. I ran a simplified version of Marcus's numbers for myself. Imagine a garage has fixed and operating costs of roughly $180,000 per month. At strong occupancy, it brings in $260,000. That leaves $80,000 before additional taxes, reserves, and unexpected repairs. Now imagine demand drops 30%. Revenue falls to about $182,000. Cars still enter and customers still pay, but the profit has effectively disappeared. If revenue falls further, the owner can lose money. That was my first real lesson in operating leverage. High fixed costs make strong periods look very good. They make weak periods dangerous very quickly, and cutting expenses is not always easy. I cannot turn off security because occupancy is weak. I cannot stop maintaining elevators because fewer drivers arrived. I cannot tell the lender that remote work reduced demand, so I would like a smaller loan payment. The building creates obligations before it creates profit. Marcus tried to replace the lost office traffic. He targeted residents, nearby hotels, weekend visitors, and event customers. He adjusted monthly pricing and offered more flexible contracts. Those moves helped, but they exposed the weakness in his original strategy. His garage was not diversified. He had hundreds of spaces, but economically, he had one customer group: office workers. When their behavior changed, the entire property changed with them. I looked back at my Austin plan and asked myself a harder question. What if the district grew, but not in the way I expected? What if commuters used transit? What if a competing garage opened? What if the city changed traffic patterns? I had been treating demand like something permanent. It wasn't. Parking demand is a behavior. Behaviors can change faster than concrete, and once the garage is built, I cannot move it to another neighborhood. That is why fixed costs were not my biggest risk by themselves. The bigger risk was being permanently attached to the wrong source of demand. And that realization led me to the mistake that destroys some parking projects before they ever have a chance to recover. The more I studied parking garages, the more I realized that a bad location does not always look bad at the beginning. Sometimes it looks perfect. That was what made the Rivergate Plaza project in Phoenix so useful to me. The garage had been designed around a large shopping center that once attracted thousands of visitors every day. On paper, the logic looked obvious. More shoppers meant more cars meant more parking revenue. So the developers built for scale. The garage had around 900 spaces. When the shopping center was healthy, that capacity looked like an advantage. Then several major stores closed. Foot traffic fell. The remaining businesses could not replace those customers, and hundreds of spaces sat empty. The structure did not become cheaper because demand disappeared. The concrete was already there. The debt was already there. The taxes were already there. That was the part I kept coming back to. Being wrong about demand could lock me into the mistake for decades. If I open a restaurant in the wrong neighborhood, I can eventually close it and move. But if I spend enormous amounts building a multi-level concrete structure, I cannot simply move it 3 miles closer to where the customers went. The location is permanent. Forecasting demand mattered more than today's traffic. Rivergate Plaza had once looked busy enough to justify 900 spaces, but the garage had been built around an assumption that the shopping center would remain the same kind of destination. That assumption failed. I began asking what could make the same thing happen in Austin. A new rail line could give commuters another way into the district. The city could reduce car access. A major office tenant could leave. A hotel project could be canceled. A competing garage could open with lower prices. Even a change in working habits could reduce weekday demand. None of those events required the neighborhood to collapse. A district could continue growing while my garage became less valuable. If residents preferred walking, rideshare, or public transportation, population could rise while parking demand stayed flat. Growth did not automatically mean more cars. I also discovered how dangerous projected occupancy could be. Suppose I expected my 500 spaces to average 80% occupancy. That meant roughly 400 occupied spaces. If my model only worked there, a small forecasting error could become a large financial problem. At 70% occupancy, I would lose 50 paying spaces compared with my target. At 60%, I would lose 100, but my loan payment would not fall by 25%. My property taxes would not fall by 25%. Most of my operating costs would barely move, so I stopped asking whether a location looked busy. I started asking whether demand would remain strong after something went wrong. Could the garage survive if one office tenant left? Could it survive if a nearby development was delayed? Could it survive if public transportation improved? Could it survive if parking prices had to fall? I wanted several independent reasons for people to park there. Office workers in the morning, residents at night, restaurants and entertainment on weekends, events now. The more sources of demand I had, the less one change could destroy the whole model. Rivergate Plaza taught me that empty spaces are not harmless. Each empty space represents capital that I paid to build but cannot monetize. If 300 spaces stay unused most of the year, I did not just lose potential revenue. I spent money constructing capacity the market never needed. That is why overbuilding can be almost as dangerous as underpricing. By this point, I no longer wanted the biggest garage I could finance. I wanted the smallest garage that could reliably capture enough demand to cover its costs, service its debt, and still leave room for profit. And that led me to the final question. If so many things can go wrong, what makes the best parking garages work so well? By the time I reached the final stage of my analysis, I understood something that changed how I judged the entire project. A parking garage does not become valuable because it is large. It becomes valuable because the right people need it often enough, at prices high enough to cover everything behind the gate. They were attached to places where parking demand was difficult to avoid. Airports, hospitals, universities, stadiums, and dense downtown areas all had something I wanted more than raw traffic: recurring necessity. That became the third major realization of my Austin project. Location was not simply about how many cars passed nearby. It was about why those cars had to stop there. Then I saw how much profit depended on operating the garage intelligently. Automation was one opportunity. License plate recognition, automated gates, digital payments, and remote monitoring could reduce the labor needed for routine entry and exit. I would still need maintenance, cleaning, security, and customer support, but every routine transaction I could automate lowered the cost of serving the next vehicle. Then came long-term contracts. A garage relying entirely on random daily customers is exposed to constant changes in traffic. A garage with agreements from nearby offices, hotels, hospitals, or apartment buildings can begin each month with part of its demand already committed. That improves cash flow visibility and makes debt payments easier to plan around. But I did not want contracts to create another Marcus Hale problem. If one company controlled half my occupancy, I would still depend on one source of demand. So I wanted diversity. A strong garage, in my mind, looked like a portfolio. Commuters, residents, hotel guests, hospital visitors, restaurant customers, and event traffic could support different hours of the same property. Then I looked at every part of the property again. Could walls carry advertising? Could premium spaces earn higher rates? Could EV charging and washing services add revenue without requiring more land? The more revenue I could generate from each vehicle, the less pressure I placed on the basic parking fee. I could not charge whatever I wanted just because I borrowed too much. The project had to work at prices Austin drivers would accept. I finally built two versions of my financial model. In the optimistic version, occupancy stayed strong. Contracts covered a meaningful share of spaces. Event pricing increased revenue during peak periods, and automation kept operating costs controlled. After loan payments, maintenance, taxes, insurance, and reserves, the garage still produced healthy cash flow. In the realistic version, construction cost more than expected, weekday occupancy was weaker, and event demand was inconsistent. Revenue still looked impressive from the outside. But after debt service and fixed operating expenses, the margin became painfully thin. That was the expectation reversal I needed. A busy garage was not automatically a profitable garage. High revenue could still produce weak profit if debt, taxes, maintenance, and operating cost consumed most of it. Owning a parking garage can become highly profitable where demand is steady, but the concrete is not the business. The real business is location, occupancy, pricing, debt, and how much revenue I can generate from every vehicle without depending on one fragile assumption. If I get those decisions right, I can own an asset that produces cash flow for years. If I get them wrong, I can own hundreds of empty spaces and keep paying for them. So if I ever build that garage in Austin, I will not judge the opportunity by how impressive the structure looks. I will judge it by the demand underneath it. Because in this business, I am not really buying concrete. I am buying future occupancy. And whether I succeed or fail,